Looking at global markets for November, it was a weaker month. We had global equities sell off around 2.5%, and this now marks the second negative month for global markets since this rally began in early 2020. Encouragingly though, if we don't see a steep sell-off or a further decline in December, we are still on track for a positive quarter in the fourth quarter of this year, and this would mark the 7th consecutive quarter that global equities have advanced since March 2020, which is quite astounding. During the month, it was very eventful with a number of key themes. We had COVID cases surging in Europe and new lockdowns and restrictions being announced. We had Jerome Powell renominated as the Federal Reserve Chair, which is a crucial data point as investors think about the future direction of interest rates. We got a look at inflation in the US. For the prior month, we found out that was 6.2% year over year. And this is the highest that the US economy has experienced since 1990. So still showing that some of this inflation and the supply chain pressures are sustaining. We also had on top of that China, and we had the property sector still remaining weak and a couple of their leading property developers edging closer towards default. And then we had some very notable events like some key price declines. We had energy, particularly in November, falling off around 20%. And that was due to two things. We had a new supply response coming through with China and the US as notable countries releasing some reserves, trying to take some pressure off of the supply issues there, but also concerns from investors around what Omicron meant for global mobility. What this meant for the returns in markets was we had a lot of the cyclical sectors underperforming, such as financials and energy. And then we had one of the only sector that actually delivered a positive return being IT, with consumer discretionary close behind. At the regional level, this meant that we saw investors really flight to some more safety, which was stronger for developed markets. The US market was a key outperformer, and we did see some of the emerging markets quite steeply underperform, particularly China. And what's interesting as we come to the close of the year, this brings the performance gap of the US and Chinese markets now to around 40%, with the US outperforming by that margin.